that debate on inflation, whether it was temporary or persistent. The debate was won by those who claim, like me, that the inflation rate rise will be persistent, permanent, rather than transitory. It's driven both by bad policy and bad luck. Bad policy being excessively loose monetary, fiscal, and credit easing for too long. Bad luck was, of course, the initial COVID shock and the impacts on labor supply, global supply chains, but now we have the Russian invasion of Ukraine, the impact on commodity prices, and the zero tolerance policy of China. Of course, if negative supply shock occur, then that leads us to the third question on whether central banks who have to raise rates are going to be achieving a soft landing or a hard landing, meaning going back to 2% inflation with a recession or without a recession. Unfortunately, history suggests that when the shocks are negative supply, that implies stagflation, growth lower, inflation higher. So as you fight inflation, you risk to lead to a hard landing and make it more likely. And of course, central banks have a dilemma. Either they fight inflation, raising rates, risking a hard landing, or if they want to protect the growth and employment, they are behind the curve, they don't tighten much enough, and then you have a de-anchoring of inflation expectation. History suggests that the hard landing is more likely than a soft landing. We're not yet in a hard landing, but we're getting there in US, in Europe, and UK by the end of the year. Some people say, well, there'll be a hard landing, but it's going to be short and shallow, mild than vanilla. I beg to disagree. There is so much debt in the system, there are zombie institutions, and now central banks are raising rates, they're going to crash. In the past, whenever we had a recession, we could ease monetary and fiscal policy because we had deflationary forces. Now we're inflationary forces, so we have to tighten into a recession. Inflation is a global phenomenon. The deflation of many asset bubbles, raising rates increases debt servicing ratios, the geopolitical risk. And in the 70s, where the inflation and stagflation problem, but not a debt problem, after the global financial crisis, where the debt problem, but low inflation because of a demand shock, credit crunch. Today we have the worst of both worlds. We have a risk of a stagflationary debt crisis because debt ratios are high, rising, and we have now stagflationary impacts. I think the central banks may eventually blink, and if they have to have a financial and economic crash, they may decide not to fight inflation. That may avoid in the short run a recession, but it's going to cause so much inflation and stagflation that at the end is going to be worse. We have medium-term factors that are leading to stagflation. They go beyond the short-term factor. It has to do with deglobalization, aging, reshoring of manufacturing, restriction to migration, decoupling between US and China, geopolitical risk, climate change, cyber warfare, backlash against income inequality, and so on. The final point I'll make is that in a world of rising inflation, is a world bad for public equities, it's a world bad for fixed income. As bond will rise, the price falls. It may be a world that is good for real estate because real estate in the short run is in limited supply, and therefore rents may rise and valuation may rise, and it could provide a hedge against inflation, subject to a few caveats. If central banks have to fight inflation by raising not just nominal rates but also real rates, and that causes a recession, then high real rates and recession is bad for any risky assets, including real estate. That's a risk, and we have a risk of a hard landing and raising rates. And then we have also the issue of global climate change. Global climate change is going to lead to a lot of stranded assets in the energy sector, in manufacturing, but also in real estate, in parts of the world where commercial residential real estate may be subject to flooding because of hurricanes, sea rise level, wildfires, and you name it. So I think that real estate is a good investment, but people have to be thinking about assets that are resilient to global climate change. Climate change can disrupt the value of many assets. So subject to that caveat, real estate can do well.